Harry, welcome back. Happy holidays to you.
Nice to be back, George.
Looking forward to this. What do you think of that story of all these people quitting their jobs?
Well, the baby boomers are in their elder years now, 60s, 70s, and even 80s. And, these type of people, like, if they are going to work, they're going to want to do what they love. And now people got a break from COVID. A lot of people paid kind of a paid vacation. And now they come back and, people just naturally like more choice. And just, one of the reasons we get disruptions in life, from thunderstorms to everything else, is just to shake things up now and then. So I think this is doing that, and it's actually a good thing. I think more people want to work from home. I've been working from home since 1989. You know how much time I save commuting to work every day? And
oh, my gosh.
Literally getting dressed up and stuff. It's huge.
I would not want to be into commercial real estate right now. What do you think?
Oh my God, yes. I mean, that's a huge thing. That's the type of thing that has changed forever, that more and more people will be able to work part-time or full-time from home. Obviously, to me, the best thing is both. I mean, I work from home, and have for a long time. I got my own business. I'm in Puerto Rico now, in the tropics. But I think the ideal is where people maybe come in and work in an office maybe 1 or 2 days a week where they can socialize more and get together with people in their company, and then spend, as much time as possible at home. It's just easier to do it. It's a natural thing. So that's a big change. That's something that's never going to come back fully. I mean, why should people spend time commuting to work and clogging the highways? Our highways up.
Harry, you still say and believe that people are drivers of the economy, not government policies, right?
Yeah. I mean, economists pretty much I took my first 3 courses, 2 were required and 1 elective in economics, and I just quit. I took everything else in business, marketing, business strategies, finance, accounting, production. I mean, everything, because that's the real nature of business. But what I discovered, just when I started my research in 1980-81, when I got out of Harvard Business School and stopped working for large companies and started working with new ventures, that's when I saw, first of all, new ventures and innovations are the driving force of technology and innovation that makes us more productive. But people, for the first time in history, we know, when I was coming along, the first research from the U.S. government, the Bureau of Labor, was released showing exactly when people spend money by age and different stages of life and sex and ethnic, everything. I mean, we know people, and people enter the workforce on average age 20, George, and then spend the most money at age 46 today. That's moving forward. It's already around 47. It'll be 48 by the time the millennials come into their peak spending. I mean, people are not only 70% of GDP in their consumer spending, but they are incredibly predictable. And so I don't have to say, well, will a Democrat be president 4 years from now or 8 years? That has very little impact. Of course it has some, but very little impact on my forecasting methods. I was able to see the entire boom into 2007 from the 80s on, when I started my research and writing books and stuff, before it happened. I mean, right down to the peak in 2007. And you know what? Ever since 2007, people ask, why do they have to constantly print money? Because we're making up after the baby boom, the largest generation in history. People peaked in their spending predictably, and the next generation, the millennials, will not take us back up strongly again until about the beginning of 2024, say 2 years from now. So we've been in this long decline, and that's why they're feverishly printing money, and that's not good policy. That just causes people to waste money and stuff. So people are predictable in their spending habits, and people are supply and demand. There's a demand for goods as they age and grow up and raise kids particularly. And once the kids leave, our spending goes down and we save more. But they're also supply. We are the supply of labor and production of goods, and people get more productive. I mean, I know young people always think they know everything in their late teens, early 20s when they get out of college, but think how much you've learned since then, anybody. So But the great thing is we have information now, and the Bureau of Labor only started their consumer expenditure surveys in 1981, just when I was getting serious about my research. When I discovered that, I'm like, oh my gosh, economists don't even know how predictable people are. Enter the workforce 20, spend the most at 46, and retire at 63, not 65, on average 63, and on and on. And inflation, workforce entry of people, deflation, people retiring. Retirement of the baby boom is a deflationary thing. People wonder how they can print so much money and get so little inflation, because a large part of our population in developed countries, the United States, are retiring and slowing down. So I've studied the life cycle of people, and then I can look at any country in the world and tell you which ones are going to boom over the rest of your life. I tell people I can tell your kids what's going to happen when they grow up. I mean, literally, I can project out that far in general booms and busts, and if there's going to be more inflation or stuff. But this is from studying people, because if you had to rely on governments, you don't know who's going to be in office 4 years from now.
And Harry, what about this inflation rate that's nearing 7%? What's fueling that? Is it COVID and the shortages of supplies? What's happening?
It is, George. This is not the 70s. People keep saying now, we're going back to the 1970s with kind of stagflation, increasing recessions and rising inflation. No, the inflation of the 1970s, which peaked in 1980, basically was the high workforce entry of young, unproductive baby boomers entering the workforce. It cost money to build offices and hire and train new workers in their workforce, okay? But once they get in after that great expense, which causes inflation, George, I tell people inflation, I've looked all the way back to Greek and Roman times where there's good data. That's where I've got my first insight studying history. Inflation, high inflation is a sign of a future boom, because high inflation is a sign of a lot of young people in our economy, but they're going to grow up and earn and spend money and become the next productive generation. So inflation is a leading indicator. This is not. Inflation should be about 1.5% to 2% now. And yes, it's 6.8, and it might get up to a little higher here because they've been printing so much money, especially since COVID. So this is a temporary thing. The 1970s was the highest sustained inflation in modern history, and that was predictable by the same thing. Workforce entry, workforce growth is my inflation indicator, and I can project that in any country in the world decades in advance. So inflation's not a fickle thing. Right now, it is higher than normal because they have printed, get this number, George, $5 trillion just since COVID.
Jeez.
$3.6 trillion in the decade before to get us out of the 2008-9 recession. But when COVID hit, they just went crazy. $5 trillion to keep this economy going just since COVID in less than 2 years. So this is short-term inflation. You're going to see inflation go from 6.8, maybe 7% down to zero or negative deflation in the next few years because we've stretched this economy so far with stimulus, and it's going to start slowing anyway because we just don't have the fundamentals. All our entire boom since 2009 has been entirely because of stimulus. The boom from 1983 to 2007 was entirely because the largest generation in history grew up and became the most high-spending, productive workers in history. Again, something I was able to predict and shout from the rooftops in the early to mid 80s, and people thought I was crazy. We have to remember.
Well, you're not crazy, Harry. That's for sure. We're going to take a break and come back and talk about the bubble. Will it burst? Next hour, we'll take your calls with Harry Dent as we talk about the economy. And when we come back, we're going to talk about the bubble. Is it going to burst? Let's see what Harry has to say. Welcome back to Coast. George Noory with Harry Dent Jr. Harry, was 2008 a bubble?
Yes, coming in. First of all, our first bubble was 95 to 2000. People forget that. Stocks went straight up. technology-led bubble, technology stock. And then even during a boom, and I was still very bullish all the way out to 2007 back then, we had the biggest crash we've seen since the 29 to 32 crash. So that was the first bubble and crash. Now, I call that a natural bubble. The economy was great. The baby boomers were accelerating the fastest. I mean, my research showed the 90s would be the strongest decade of the 80s, 90s, 2000s, and up until recently, okay? So that bubble burst. Well, now we've had a second bubble, okay, since the 2008 downturn, because that was the worst downturn since the Great Depression. Worse than 1980 to 82. That was the lowest point in demographics after the last generation's spending peak in the 1960s. And here we are coming into this one. So this is the second bubble. This bubble is greater. I'll tell you, everybody in this audience, you go look up, your assignment, go look up after this, the stock market. You can look at the Dow, the S&P 500, the NASDAQ. You can look around the world, but look at those leading indicators. Look at the stock market just since COVID, just since March of last year. This has been the most straight up thrust, more than any time in the Roaring '20s, more than the first tech bubble in the '90s, and those were both historic times in the stock market, bullish times. This is straight up because they're printing that $5 trillion in all central banks around the world. They injected trillions and trillions of dollars into the monetary system. People need to understand, when they do this money printing, they're not printing dollar bills. They are literally buying money creating money and buying bonds in the financial asset system. They're injecting new money on top of normal investors, trillions and trillions of dollars, which pushes up all financial assets, bonds, stocks, real estate, everything. So what it creates is not, people keep saying, oh, they're going to cause inflation. No, we've had very little inflation, and only recently, and like I said earlier, that's temporary. It's creating the biggest financial asset bubble in history, particularly stocks. And so what happens? They have to crash. It gets so bubbly, and bubbles don't even need a recession, although that's inevitable too. These bubbles crash at their own extremes. But look at that stock market chart. Anybody looks at that and says this is not a bubble, they don't have their eyes open. Bubbles of this nature always crash, and they crash twice as fast as they build. So if we built the greatest bubble in history in the last several years, the next 2 years, maybe 3, is going to see the greatest crash of our lifetimes. This is virtually guaranteed from my research.
What would you categorize the crash of 2008 on a 1 to 10, 10 being the worst?
That was a 9. 1929 to 32 was a 10. This will be a 10. So that was an 8 to 9. This will be a 10. This is the greatest bubble we'll ever see. We won't see anything like this the rest of our lifetimes, particularly people, baby boomers, more my age and stuff, okay? But this will be the greatest crash we will see in our lifetimes because these things don't, on this magnitude, again, the greatest crashes were 29 to 32 and the 2008 to 9 was a very large crash. And this one will be the biggest one we see. So this is something to get serious about. I tell people, look, real quick, I have a newsletter like most forecasts and stuff, but we have a free newsletter where you get 2 articles or 3 every week to keep up with our thinking until, just to get to know it, because I know what I'm saying is different than most economists. We have a whole different approach. I always have. Again, looking at people is not what economists do and understanding how predictable are. So this is a good time to just get to know it. HarryDent.com. You can at least get on this free newsletter, and I think you're going to see very soon that I think this is going to be the fastest change from boom and bubble to burst we have seen. This is going to be stronger, and think back, stronger than that 2000 to 2002 tech bubble crash, and that was a 78% decline in the NASDAQ and tech stock. I'm predicting an 87%, give or take, declining in stocks in just the next 2 years. And more than that, George, and this is what makes it so hard, and people don't understand, the first crash out of a bubble like this, and I've studied every bubble around the world in the last 100-plus years, the first crash tends to average 46% in just 2 to 3 months. And this crash, now that we've bubbled up so much, I'm projecting just the first crash in the first couple of months when this happens, and I think the first quarter of this year is going to be that, it looks like 55%. Stock's going to go down something like 55% before people can even blink, and then people will panic and sell, and then it will bounce back for a few months, and people say, oh, my God, why did I sell? And then you'll see this long 2-year decline, bigger, more compared to the 29 to 32 crash. Again, this is a once-in-a-lifetime event. I know this sounds like extreme. I'm not an extreme guy. Okay, I've been forecasting for 40 years. I'm usually the same guy, when people are too bullish or too bearish. This is extreme. This bubble has been stretched. And all you got to do, like I said at the beginning of this, look at the stock market just in the last 2 years compared to the whole boom. This is the greatest boom in history, the longest and the greatest. The last 2 years since COVID is just off the charts. Bubble of all times. There is only one way that can end in history, and that is a sharp, quick, deep crash.
Is there any way, Harry, it can be stopped?
No, not at this point. When you stretch it this far, it has to come back. And balance is good. In other words, I especially young, okay, I'm a baby boomer and I'm older, okay? But for young people coming along and just starting to save for the future, would stocks stretch this high, the highest in history, and these high values, they have no chance of making decent returns so they can retire in the future. So the best thing that could happen is to let the stock market and the economy come back into balance after these two giant bubbles. Again, the first one was natural, okay? This one is 100% artificial, created only by nonstop stimulus now for almost 12 years. George, this is crazy. This is going to go down in history. People are going to say, what were they smoking?
Oh,
think you can live off of printing more money every year and think you can create a sustainable boom. This is nuts.
What's going to bring it back?
Okay, the millennial generation, the next generation. And I've been saying this, the baby boom was what caused the boom from 1983 to 2007, greatest boom in history, and the longest, okay, because of the size of the generation. Well, the millennial generation only takes us back to the levels of baby boom peak spending, but that's still huge. I mean, after this downturn and stuff. So 2024 into 2037 is the next boom. Notice not as long as the 1983 to 2007 baby boom, natural boom. That's the next boom. But we need to write off a lot of debts. There's 23% of public, large companies that can't even pay their debt service. They're called zombie companies today, and that's rising because they're only alive because money's so cheap and easy, and they keep the economy going artificially. We need to flush out these bad companies. They're wasting resources and people, and then the millennial generation will naturally drive a boom again. But that boom is going to be very, very compromised if we don't get rid of a lot of bad debt and a lot of zombie companies. Again, 23% of public companies can't even pay their debt service, okay, and only being kept alive by stimulus. We got to flush this stuff out. That's going to be painful. That's why I'm saying if you can just be more safe and conservative, be in high-quality treasury bonds and safer investments for just the next couple of years until we have this great reset, I call it, everything will work in your favor. You're going to be buying stock for 20 cents on the dollar. Who doesn't want to do that and be able to invest in the next boom generated by millennials? Now, the millennials are the U.S. and Europe, okay? That's nothing compared to the Indians that are going to do in the next 30, 40 years what the Chinese did from 1980 until recently. The Chinese were the first large emerging country to move, into much higher spending and growth and a big demographic surge. India has stronger projections from my research than even China, and even Indian economists don't think India can ever outdo China. I'm telling you, India is the next big thing, and they're going to dominate the next boom far more than our millennials. But even in this country, it's the millennials are going to bring us back, and we are cheating these younger people if we don't get rid of all our bad debts and excessive stimulus. Stimulus like this only causes people to misinvest. That's why governments shouldn't over-tinker with the economy like this.
Have you ever been wrong, Harry, in any of these predictions over all your years?
Yes, I mean, I basically never. When I say a major turn is coming, only early, and of course, I've been warning that this is an artificial thing. I was the only guy who was bullish in the late. When I was in the late '80s, people thought I was crazy. Everybody thought Japan was going to take over the world, and the U.S. was a has-been in the '80s. You know, we had our great boom in the '50s and '60s, which we did. We led that.
Oh, we did, but we really didn't stop, did we?
No. Well, again, nobody saw, even though we were a wealthier, maybe slower growth company, nobody saw the baby boom coming. My biggest aha was I was consulting the Fortune 100 companies with Bain & Company in the early 80s. Okay? I got bored with that because large companies are so cumbersome and slow, and started to do the same strategic consulting with new ventures in California. And when I saw these new ventures doing, really innovative things, and what I had to do is I had to study their customers. Their customers weren't the old Bob Hopers, I call them, back then. They were the younger baby boomers. So that's when I saw, when I was studying for my new venture clients, I was studying what's the future. I was looking at their customers. I'm like, oh, my gosh, these are young boomers, and oh, my gosh, there are a ton of these people going to grow up and spend more money. That's what turned me on to demographics when I jumped from the Fortune 100 world to the new venture world.
Does China experience bubbles over there?
Oh, yeah. China is the biggest bubble in the world, and I'll tell you where people get hit in the bubble, George. Stocks, okay, that's bad. Okay, 29 crash, that was bad. But the richer people own most of the stocks. Everybody owns real estate, okay? And real estate, the greatest bubble in history of all times today is in China, okay? Australia, where I lecture a lot, and I haven't been able to travel now for a year and a half. I've lost a lot of money on that. Australia has the biggest bubble in the developed world. Wow. Because they have so much immigration from Asia driving their market. So real estate is the biggest bubble, and we have a second real estate bubble, because remember, we had a first one after the stock bubble crashed, 2000, 2002. Everybody switched to speculating in real estate, so we had a real estate bubble in 2006, and we had a bigger crash in real estate in the 2008, 9, 10, 11 than we had in the Great Depression, because real estate didn't bubble up in the Great Depression because you couldn't get easy mortgages back then like now. So real estate is the bubble that hits most people the hardest. And now we have a second real estate bubble, and people keep saying, oh, this one's not as bad as... No, real estate prices adjusted for inflation, adjusted for income, everything, is now higher than the last bubble that crashed 34%. George, I am predicting that this real estate bubble will also be worse than the last bubble, just like stocks, and it will be 40 to 50%. Now, it's one thing your stocks go down, and a lot of people don't own a lot of it. Almost everybody owns real estate. So this is what really hits. And Chinese real estate, China is not, they have a fraction of our income, but they have 75% of their net worth in real estate in China. China's got the biggest real estate bubble, going to have the biggest real estate crash, and China will never be the same after this, and it's just going to open the door to investing in India. India is going to be my number one country to invest in coming on the other side of it.
And doesn't China have a lot of real estate in, like, Vancouver, Canada?
Oh, yeah. Chinese are big buyers in the West Coast. And, yes, Vancouver, which, by the way, is my favorite city in North America for going to. Vancouver is where you see the most Chinese investing. And, again, it's not good when you see people speculating in areas they speculate. So Vancouver is going to be, along with San Francisco and L.A. like that, but even more so, Vancouver is going to be one of the biggest crash cities in real estate because of Chinese buying. They love buying real estate, especially in Vancouver.
Or with Harry Dent Jr., his website is his name, harrydent.com, linked up at coasttocoastam.com. We're going to take calls with him next hour here on Coast to Coast. So jump on board. Most of the lines are unavailable already because people are on hold waiting to talk to you, Harry. During the COVID situation, they threw what was called PPP money at companies to support them in employment. Are they still going to do that again? That was free money.
Oh, I mean, and this is this is really terrible. Almost any business, and I've talked to many and people that work with business consultants. It's you just pick up the phone and get instant money. They're so desperate to get out of this downturn in 2008, 9, and all this stuff since that. Yeah, it's just free money, but it's indiscriminate. Okay, it's one thing. What I would do is if I was the government, the way I'd be helping the economy, I would be giving banks some help when they write down bad loans. The biggest thing we can do is get bad loans out of the way so we make more way to make good loans. So you got to get the bad loans out of the way first. No, the government's giving every incentive to banks to keep bad loans going, and then that leaves less ability to lend money, especially the younger up-and-coming and new business, to get good loans. And so I mean, the only way to get out of this, there is no solution at this point. We stress the bubble. The bubble has to burst and let things rebalance. And again, what it means, high unemployment for a while, that's what hits most people, but what it most means, financial assets, stocks, bonds, real estate, especially risky bonds, junk bonds and stuff, and foreign bonds, they're all going to have to come back down to normal. And that, again, this is why once in a lifetime, like 1929 to 32, you don't just see a sizable stock crash, you see a giant stock crash, because that's resetting bubbles back down to normal so we can grow and invest again. It's a good thing. We did nothing but grow after that 29 to 30.
All right, let's take calls with you, Harry, when we come back in just a moment on Coast to Coast AM. Let's take your calls with Harry Dent Jr. when we come right back on Coast to Coast AM as we talk about the bubble. Welcome back, George Noory, along with Harry Dent Jr. Harry, when the boom comes back, how big will the boom be?
Well, it will not be as long as 1983 to 2007 or as steep in the U.S. But you got to remember, like I said earlier, we saw what China did from 1980 to recently. India is going to do that. India's going to have 1.6 billion people a few decades from now, while China actually shrinks. And India already projects higher GDP per capita at the same stage China's just went through. So the biggest story is going to be Asia, the Asian boom, led this time, continued by China, but much more led by India. And people don't see what a sleeping giant that is. So our millennials drive us back up, but the real growth is going to be led by India. And nobody sees that coming.
Harry, what was it that got China to explode and become such an economic powerhouse? I mean, during the war, World War II, they were just a large country with no major assets. I mean, everybody was taking advantage of them. And then all of a sudden they exploded. What caused that explosion?
Well, first of all, historically, if you go back hundreds of years, China was a great power and greater power than Europe, if you go far enough back. But China did recede. They turned on the world in the mid-1800s. And China is really an everyday third world country in 1980. But what happens, the advantage of China is also its disadvantage. They are a top-down, centrally managed economy, okay? That is not good for economics long-term. That's why the U.S. has done so well compared to the rest of the world. But they decided they were going to urbanize more rapidly. And, George, I'm saying, two things really drive growth. A generation of people going from young and expensive and inexperienced to highly productive in their 40s. Okay,
right,
that's number one.
Right.
The number two thing is urbanization. You move people from rural areas, and China was totally rural back then, 3 times the income in emerging countries like China or Brazil or whatever I studied. 3 times the income people live in cities move to cities. So they decided we're going to urbanize and we're going to supercharge it. So China, and here's the bad side, George. China has 22% empty houses and condos and office buildings, okay? That's terrible. That means when this thing crashes, oh, my God. And remember what I said earlier, 75% of the net worth of average Chinese household is in real estate. It's only 30-something in the U.S. So
wow.
This real estate bust, their bubble is much bigger than ours. China is going to be the disaster in this next couple of years. And everybody, and they're not going to come back and be the same. I would be telling people to invest in India when this crash happened, and in aging sectors in the United States and Europe. So again, demographics always tells you where to go, which countries and which sectors of countries, and it's one of the most predictable things. Once we're born, we know what we're going to do at different stages of our life, spending, investment, everything, lifestyles, and we can project this for decades. I mean, I'm talking decades. I can literally tell your youngest kid what the economy is going to look like when they're at their peak, of their life and life cycle 10, 20, 30, 40, 50 years ago. I can go out that far with the greatest of ease. Didn't
China build a city, skyscrapers, housing, and there's nobody in the city?
Yeah. They have one whole city, and they have whole parts of cities that are
empty.
China just says they know they're going to need in the future, although they don't understand their demographics are actually declining. They just said, we're just going to build it and worry about it later. Because, again, they wanted to become a great country first. And so they did do that. That's the good story. The bad story, now that their demographics are down forever. They have already peaked in 2011. That's years ago. And they've already built enough real estate for everybody else that would ever need a house. They're never going to need to build new houses again. They have overbuilt everything. So China saw the greatest boom in the last 30 years. They will see the greatest bust. And India will come out of this leading the next boom. And the United States will still trump the other developed countries like Europe, because our millennial generation, Europe doesn't have a millennial generation, by the way, okay? Japan hasn't had one ever since their peak. So we're the best developed country, and India is the most opportune, and Southeast Asia as well, is the most opportune areas in Asia. And again, demographics and urbanization trends